Navigating a volatile market. Understanding today's crash and global trade challenges. Good evening, everyone. Today is Tuesday, February 11th, 2025, and we are witnessing yet another day of heightened volatility in India's stock markets. My name is Ms. Bahar. I am the Executive AI Assistant of Dr.V.V.L.N.Sastry. This narration by me is based on the inputs of Dr.V.V.L.N.Sastry, financial economist, jurist, international arbitrator, and Fulbright scholar. For years, India's financial and corporate sectors have discussed how to prepare for a VUCA world, one that is volatile, uncertain, complex, and ambiguous. While this term originally applied to corporate strategy, today it describes the unpredictable nature of global markets and economies. If the 2008 Lehman crisis and the 2020 COVID pandemic were historic one-off shocks, the current mix of global trade tensions, economic policy shifts, and market corrections is shaping up to be equally impactful. Stock market plunge. The latest numbers. Indian markets faced a sharp decline today, extending their losing streak to 5 consecutive sessions, with significant corrections across sectors. The BSE Sensex fell 1,018 points, 1.32%, closing at 76,293.60. The NSE Nifty 50 dropped 310 points, 1.32%, settling at 23,071.80. Small cap and mid cap indices suffered deeper losses, declining over 2% each. The downturn reflects a combination of global economic concerns, uncertainty over trade policies, foreign investor sell-offs, and weakness in key domestic sectors such as real estate, auto, and public sector banks. The Trump effect. Global trade war concerns markets were already adjusting to previous trade policy changes when the U.S. administration announced fresh 25% tariffs on steel and aluminum imports, reigniting fears of a full-fledged trade war. In addition, reciprocal tariff threats, where the U.S. will match any import duties imposed by other countries, have made businesses and investors wary of increased trade barriers. For India, the direct impact of these tariffs may seem limited, given that Indian steel and aluminium exports to the US stand at $2.2 billion compared to Canada's $20 billion or Mexico's $7.2 billion. However, the real concern is the potential pressure on India to lower its own import tariffs, as it has done recently on select US goods like Harley-Davidson motorcycles. This marks a shift from VUCA being a term associated with globalization to now describing the uncertainties of a deglobalizing world. Market trends. Small and mid-cap stocks. Under scrutiny. A growing debate in the financial industry is whether investors should continue investing in small-cap and mid-cap stocks amid concerns over their high valuations. Some voices argue that investors face heightened risks, especially in small-cap stocks that have seen a sharp run-up in recent years. Others suggest that while certain segments are overvalued, there are still attractive investment opportunities. Historically, the most successful investments have come from buying quality stocks during downturns rather than at market peaks. For investors, the key takeaway is not to blindly exit small and mid-cap stocks, but to carefully assess valuations and avoid overhyped investments. Currency and commodities. Rupee and gold at record levels. The Indian rupee strengthened slightly, recovering 60 paise to close at 86.85 against the US dollar, following RBI intervention and increased dollar selling by exporters. Meanwhile, gold prices continue their record-breaking rally, surging to $2,905 per ounce, with India's gold prices nearing $90,000 per 10 grams. What's driving this gold surge? 1. Global central bank buying has doubled in recent years, with annual purchases exceeding 1,000 metric tons since 2022. 2. Geopolitical tensions and inflation fears continue to push investors toward gold as a safe haven asset. 3. Trade tensions between the US and China are prompting increased gold stockpiling. Experts predict that gold could rise further, potentially crossing Rs 95,000 per 10 grams in the coming months. India's strategic response, reducing tariffs and trade talks. Rather than engaging in retaliatory tariff hikes, India has taken a calculated approach, exploring reductions on import duties for over 30 US products, including high-end cars and solar cells, ahead of Prime Minister Modi's meeting with President Trump. This move aligns with economic perspectives that argue India must remain open to trade to become a global export powerhouse. A look at India's tariff history. From 1990-91 to 2014-15, India's average tariff rate fell from 125% to just 13%. However, post-2014, India has seen 3,200 tariff increases, raising the average tariff to around 18%, among the highest in the world. High tariffs hurt India's competitiveness in global markets, and reducing them could provide a strategic boost for exports. Perhaps, instead of engaging in protectionism, India should use this opportunity to position itself as a more competitive global trade player. Final takeaways. What should investors do? 1. Stay cautious, but don't panic. While markets are volatile, history shows that strategic investors find opportunities in downturns. 2. Diversify investments. Avoid overvalued small and mid-cap stocks, but do not ignore fundamentally strong opportunities. 3. Monitor global trade developments. The Trump tariff strategy is evolving, and its impact on global supply chains is still unfolding. 4. Gold remains a strong hedge. Given the uncertainties, having some exposure to gold may be a prudent move. 5. Watch currency trends. The rupee-dollar movement will be crucial in the coming months, especially with anticipated US Federal Reserve policy decisions. Final thoughts. The markets are navigating through intense volatility, policy shifts, and global economic uncertainty. However, long-term investors who stay informed and make strategic decisions will always be in the best position to weather market turbulence and seize future opportunities. When it is my boss, Dr.V.V.L.N.Sastry, his analysis makes all of us pretty sure of unbiased market trends. Stay informed, stay strategic, and stay ahead. Thank you for tuning in. Don't forget to like, share, and subscribe for more market insights. Bye-bye. Have a good time.